Okay, hi everyone. This is going to be the second lecture for Chapter 9, the PowerPoint video. So last time we looked kind of at sort of additional issues with inventory. We talked about that retail method. You can look at the dollar value, LIFO retail, just look it over, not as concerned with it. It gets a little bit tricky and complicated there. So just be aware it exists, but I'm more concerned with the other items in that lecture. So after that point, we're going to pick it up here in the lecture. Okay, so what happens if we change inventory methods, right? So you think about it, hey, here's year one, here's year two, right? Maybe we're using FIFO, we're using FIFO, and then in year three, we want to change to average cost, right? What do you do here for it? Well, it depends in part on what you're changing to, right? If you go to anything other than LIFO, right, the general rule is going to be you're going to deal with it retrospectively. And what that means here is, right, retrospective treatment, you will go back to year one in year two, and essentially you will revise those financial statements as if you used the average cost method, right? You'll adjust the affected accounts, right? And you will make sort of, a disclosure there to account for that, right? So the general rule is going to be retrospective treatment, go back, restate them, adjust accordingly. The exception is whenever you go from something like FIFO or anything to LIFO, right? When you're going to LIFO, then essentially what you do in this case is you're going to deal with it prospectively, right? And what that essentially means is just start from year three and use it from there moving forward. You don't go back and restate those items. So here's an example, right? We have a company. It looks like they began 2021, and that was when they were formed. In 2023, on their balance sheet, they were using the average cost method, and it looks like their inventory was 123, right? So 123 under the average cost, right, was their ending inventory. Hey, it says here in 2024, right? So this was for, we'll just put year one. Average cost 123. For 2024, they decided to change to FIFO, right? So year two, they want to change to FIFO. Had it used FIFO, right, in 2023, the ending inventory would have been 146. Okay, so it would have been 146 had we used FIFO over here. So you can see, right, there's a difference there, a $23,000 difference. We needed bigger inventory. So what we'll do is, right, because we're changing to something other than LIFO, we'll go back, kind of restate that year one as if we used FIFO. And then, hey, to get us where we need to be, right, we'll do a journal entry to increase our inventory and then decrease our retained earnings. In other words, because we're putting our inventory back on the books, we kind of have to undo the journal entry when we sold it, right? Debit cost of goods sold, right, which is increase in expense, which decreases net income, which decreases retained earnings. So this guy right here is going to undo that decrease in retained earnings through a credit. Okay. Likewise, right, we will, disclose accordingly in that case. So you can look at this CVS example. How about if we change to LIFO? right? We're going from any other method to LIFO. Well, hey, it's going to be hard to go back and restate those things with the different layers and assumptions. So we're not going to do that, right? Essentially, what we're going to do is treat it prospectively, right? From this point on, hey, we're just going to use LIFO, and the base year inventory is going to be the inventory at the beginning of that year that we adopted. Okay, so a little bit easier there, right? You can see, hey, we're going to have to disclose, right? Talk about the nature and justification of the change, why retroactive application was impracticable for it, right? We're going to LIFO. That's hard to go back and trace that. And then, hey, what are the effects of the change? Okay. So, here's an MCQ. You can look at it, right? It looks like they're going from average cost to FIFO, right? Inventory in 2023 was at 55. Had we used FIFO, it would have been 50, right? So they're saying here, what are the effects on retained earnings? Well, in this case, right, we were at 55 under average cost. We would have been at 50 under FIFO, right? We got to take it down by 5, right? So in this case, right, we'll kind of do the flip of that journal entry we saw before. Here, we're going to do debit retained earnings by 5, credit inventory by 5. So the answer there will be, retained earnings would have a $5 million decrease right there, the debit. Okay, let's talk a little bit about inventory errors, right? So we know inventory, it's going to be like your beginning plus your purchases minus your sales gives you your ending, right? If when you're doing that, you can have an error, kind of like an uh-oh, a boo-boo. You could have, maybe had a mistake in the physical count, right? When you were figuring out your ending inventory, you counted too many, you counted too less, you screwed up the pricing, or maybe you inaccurately recorded your purchases, right? In some way, this kind of calculation, this formula for inventory, you got screwed up. What do you do when this happens? Well, it really comes down to when do you figure out that you screwed up the inventory? If it's in the same accounting period, right, essentially what you're going to do is just correct it right then and there, right? The original entry should be reversed and the appropriate entry should be recorded. However, maybe it's a couple years later, then we find out, uh-oh, we screwed up the inventory, right? Well, if it's discovered in a subsequent accounting period, right, previous financial statements should be restated. Incorrect balances are corrected by a journal entry. Right, correction of retained earnings is going to be reported as a prior period adjustment, right? So PPA, prior period adjustment. We've got to get our retained earnings to where they should be. And then we're going to have a note for it. Okay, so let's kind of think about this here for what's going on. Here's the equation, right, for inventory rearranged, right? Beginning plus purchases minus ending gives you cost of goods sold, okay? If you screw up one of these things, right, it is going to screw up your cost of goods sold. If it screws up your cost of goods sold, it's going to screw up your net income. If your net income is screwed up, it's going to screw up your retained earnings, right? It's like, it's like the whole financial statements here. It ripples through, right? It's like a domino effect. If you do this, things are going to get screwed up with it. So that's kind of the setup with it. If you think about an inventory error, it's going to screw up your balance sheet. It's going to screw up your income statement. It's going to screw up your statement of retained earnings and stockholders' equity. Okay. So if we were to look at it, right, let's look at an example here on here. So it's the Barton Company uses a periodic inventory system. At the end of 2023, an error, right, caused an $800,000 overstatement of ending inventory, right? Our ending inventory is too big by $800,000. It says ending inventories for 24 and 25 are correctly determined. Assume the error is not discovered until after 2024, okay? So first off, let's kind of compare this, right? We got 24 and 23 here. How does this affect 23, right? Well, if our ending inventory is too big, then our cost of goods sold is going to be too small, right? If our cost of goods sold is too small, our net income is going to be too big. If our net income is too big, our retained earnings are going to be too big, right? But check it out, right? Last year's ending is this year's beginning, right? So last year, this guy was overstated, right? We're just carrying that up arrow over here. It's too big. Well, for 2024, if beginning inventory was too big, cost of goods sold is going to be too big. If cost of goods sold is too big, net income is going to be too small, right? Ultimately, what happens here, right, if you think about it, right, our net income was too big in year one, but it was too small in year two. So the upshot of this is it kind of, after 2 years, right, when you run this through the effects down here and the effects down here, it's going to kind of self-correct, right? It will put you where you should be on it, right? It's corrected by the time you hit that retained earnings. So yeah, you can have an error over here. It's going to screw it up, but eventually it will kind of reverse itself out after a 2-year period, right? So that's what this guy is saying down here. So how does this work, right? It says ending inventory for 24 and 25 are correctly determined. For 2023, right, what's going on here? Ending inventory is too big. Net income and retained earnings are too big, right? So ending inventory is too big. Net income and retained earnings are too big. If we discover the error in 2024, right? So we have 23 and we have 24, right? If in 24 we say, oh, we screwed up, we discover the error over here, essentially what we have to do is then correct it, right? So here to correct it, right, ending inventory was too big, we're going to have to make it smaller. Retained earnings was too big, we're going to have to make it smaller, right? So if we discover it before it kind of self-corrects itself after that 2-year period, we need to do the journal entry there for it, okay? Now, right, let's say the error is discovered in 2025, right? So we have 23, we have 24, and we have 25, right? Here was the error, right? In 25, we discover that error, right? Well, we looked at kind of the effects of this and we said, hey, by the time this ripples through 2024 after a 2-year period, it's going to self-correct, okay? Accordingly, because it's self-corrected, we don't need to make a correcting journal entry, right? All we're going to have to do in this situation in 25 is make a disclosure note, right? Just, basically notate that this happened over here, okay? Okay, let's talk a little bit about earnings quality. So be aware, right, whenever you have those inventory write-downs, right, where you're going to do something like debit, cost of goods sold, credit, inventory, right, you got to write that down and you have an increase of an expense. you have to carefully look at financial statements to make sure they're kind of appropriately and effectively doing this. By overstating write-downs, profits are increased in future periods as the inventory is used or sold. So this is just saying, hey, financial analysts, whenever you would be looking at a company and they're doing write-downs, investigate those, make sure they're kind of accurate and reasonable. So you can look in the notes down there at some sort of like maybe more like fishy or skeptical situations where that happened. So here's an MCQ with an inventory error. So they tell us here beginning inventory was too big, right, by 49,000. Ending inventory was too small by 79,000. So if you looked at these kind of in a vacuum, what are the effects of it? So cost of goods sold then, essentially if you have too big beginning inventory, that's going to make your cost of goods sold too big. If you have too small of ending inventory, that's going to make your cost of goods sold too big if you were to kind of like ripple through and run the numbers on that. Accordingly, here the 49,000 plus the 79,128, right? That's going to be the overstatement of the cost of goods sold, how much it's overstated if you were to take these two things. All right, let's talk a little bit about purchase commitments. So contracts that obligate a company to purchase a specified amount at a specified price on or before a specified date. So it's kind of almost like a futures contract, if you've ever heard of those. It's something like, here we are right now, we agree at some time in the future we're going to buy these goods, whatever they are, at a certain price. We can buy it at that day or beforehand, right? When we buy it, we'll just call it the strike price, like what we pay or what the market is on that day, right? So we're going to compare what we agreed to up front, right? So we agree that in the future we'll buy these goods for $1,000, right? Why we do that is it kind of protects us against the ebbs and flows of purchase price changes, right? At least we have this down, right? We know we're right here. In the future, we're going to pay for that. How do we account for this situation, these kind of purchase commitments? Well, first off, as it has here, right, inventory is going to be recorded at the lower of the contract price or the market price on the date the contract is executed. So whenever we, strike on this, we actually buy it, right? Whether it's on that exact day or beforehand, our inventory is going to be the lower of the $1,000 or whatever the market price was on that strike date. Maybe if it was $800, then we pick $800. Let's look at an example here to give it some numbers because it kind of always makes more sense with numbers, right? So in July of 2024, a company signed two purchase commitments, right? The first commitment requires them to purchase inventory for $500,000 by November 15th. The second purchase requires them to purchase inventory for $600,000 by February 15th. Looks like they have a fiscal year end of 12/31. They use a perpetual inventory system. Okay, so here we are in July, right? Let's say, right, we have one in November, right? We say, hey, we'll pay $500 for that stuff. And then we have one in February where they say, hey, we agree to pay $600 for that stuff. So the question here becomes, right, our fiscal year end is 12/31, right? If we were to look at this, right, so it says, let's study the purchase commitments. In July, they have two purchase agreements, blah, blah, blah. The contract period for the first commitment is contained within the fiscal year, right? That makes sense, right? We're in here. This is within our fiscal year end. It says Lasseter would record the purchase of the contract price if the market price of inventory at the date of acquisition is equal to or greater than the contract price of 500,000. Right, so whenever we strike on this, right, we actually take them up, whether it's in November or, it could be beforehand if the contract allows. If at that point in time, right, the market price, what this thing is now worth, and I'm just going to put at the strike date, is greater than or equal to 500 bucks, right, then we will just use the 500 bucks, right? So here we'll do debit inventory for 500 bucks, credit cash, right? So maybe we buy it right here on November. The market price is 600 bucks, right? Essentially, then we will, because it's greater than or equal to 500, we'll use the 500. In short, the lower of the two. If the market price is less than the contract price, well, then we're going to have to essentially have a loss here, right? So again, we have sort of July, we have November. This guy was for $500, right? We have our fiscal year end, right? It's within our fiscal year end. And let's say on the strike date, this thing was worth, the market price is $425, right? So in short, if it's less than 500 at the strike date, then we're going to have a journal entry with a loss in it, right? Over here, it was greater than or equal to 500 on the strike date. Here, it's less than 500. Again, what we're doing is we're just picking the smaller of the two. Here, 425. So what's going on? What's the journal entry on the strike date? Well, we got to pay 500, right? We agreed to that's what we're paying. We'll put the inventory on there for 425, the lower of those two, and then we'll hit a loss for the difference. Okay? So that's kind of for November, right? Here, right, if you think about it, what do we do, right? Because we were in July, right? We have our fiscal year end, 12/31, right? So this is year one. And the second commitment is in February of year two, right? Well, what we do here is when the contract period extends beyond the fiscal year end, okay, we said over here, we agree that we're going to pay 600 bucks for this thing. What we essentially do, so it says, let's consider the second one. If the market price of the inventory at the end of the year is equal to or greater than the contract price of 600, so what we do is we say, okay, end of the year, we look at, what this guy right here, these goods, what is the market price, right? And if, right, the market price at year end is essentially greater than or equal to $600, what we agreed to, we're not going to have any journal entry, right? No journal entry is recorded, right? So if we looked here and, hey, was it $700? Hey, the lower of the two is 600, it's good. However, right, if we looked at this, right, and the market price at year end is less than 600, right? I don't know, let's say here it wasn't 700, let's say it was 540, right? We got to pick the lower of the two. We're going to have a loss, right? 600 versus 540, so we're going to do a journal entry, right? If it's less than, right, we have pick the lower of the two, we're going to have a loss here. Debit, estimated loss on purchase commitment. Credit, estimated liability, right, on there. So we're going to tee up this liability here, and then you'll have the estimated loss on it. Let's see what it says here. If market price is unchanged or increase from year end. Okay, so let's say in this situation, if we go back here to this guy, right? Let me kind of just draw that out again. Right, we got July, we got February, right? We said that we're going to pay $600 for this thing. Here we are at the end of the fiscal year end, and we said, oh, the market price is only $540, and we did that journal entry that we just saw, right? If we kind of continue here, right, from whenever we do this journal entry at year end to February, right, whenever we actually strike on this, if nothing changes, in other words, if on the strike date, right, in February, it's still $540, if it's unchanged or increased from year end, then essentially what we do is we're going to, right, we teed up this estimated liability for 60, right? Now we're going to get rid of the estimated liability for 60, so get rid of that. We agreed to pay $600, so we got a credit cash for $600, and then hey, we'll hit inventory for $540, what it's worth, right? So that's kind of comparing what we did here at year end with what we do on the actual strike date, if it remains the same. And if it got bigger, right, on there, we would account for it accordingly. What if it declines even further, right? So we had July, right? We had February over here. Here's our calendar year end, right? We said it was at 540. We agree to pay 600. Because it was smaller right here, we do that journal entry that we saw. But then time passes, right? And we come to find out that now on the strike date, the market price is actually 510, right? It's gone down even further, right, from what we originally did there. So what we got to do here is, right, on the strike date, we're going to do credit cash for 600. That's what we agreed to pay. Get rid of that estimated liability, right, that $60,000 we teed up. We're going to debit inventory for the 510, right, essentially the lower of those two. And then we're going to have an additional loss for the additional 30, right? It's kind of like we went from 600 to 510. That was 90,000. It went down. 60 we already counted for in journal entry 1 right here. The remaining 30 we accounted for right there. Okay. So there's a final kind of MCQ you can look at on there. We're now at the end of chapter 9, so I'm going to stop the recording here.